China's economic growth has been truly remarkable, consistently achieving a 5.5% growth rate year after year, regardless of the size of its economy. This is particularly impressive when you consider that China has over 1 billion people. It almost seems like a miracle, doesn't it? But what if we told you that the Chinese Communist Party, CCP, has managed to deceive everyone? Their most significant accomplishment isn't the astounding economic growth, but rather convincing the world that they've achieved miraculous growth. China's ascent appears nothing short of a miracle. This revelation comes as China's GDP surged by 5.5% in the half of the year, following 3 years of grappling with the widespread challenges posed by the COVID-19 pandemics. This unexpected growth has raised questions about the accuracy of China's official numbers. China released its GDP figures, catching the entire world by surprise. They reported a 5.5% year-on-year growth rate, significantly higher than what most experts had anticipated. According to a Reuters poll, the majority of experts had predicted a growth rate of only 4%. Even the International Monetary Fund, IMF, had been consistently lowering its forecast for China's GDP growth. This stark difference between the official numbers and expectations begs the question: could China be providing inaccurate data? While the Chinese Communist Party, CCP, has a questionable track record, especially concerning the treatment of ethnic Uyghurs, what's even more surprising is the lack of transparency around reported deaths. But before we dig deeper, you can support us by subscribing our channel. That will help us a lot.
All will be covered today in China Undercover. You find our information helpful. Please subscribe and turn on the notification. It will help us get more motivation to produce more quality videos. Now back to the news.
Now, let's briefly examine history. China's GDP has undeniably shown substantial growth, as seen on the chart. But who's responsible for tallying this GDP? We can't naively believe that numbers always tell the truth. Sometimes you need to delve further. How is GDP calculated? You're probably familiar with the basic GDP formula. GDP equals the sum of consumption investments, government spending, and net exports. In China, it isn't operated in that way. GDP figures are calculated and reported by local governments in the CCP, which raises significant concerns. China's political landscape differs from the U.S., not in terms of communism, but in how they assess economic growth. The U.S. measures it, while China sets growth targets. Initially, this doesn't seem problematic, but issues emerge. A straightforward method for a government official to boost GDP is to approve increased government spending, which many Chinese officials have done. However, unlike the USA, where the central government provides funding to local governments, in China, the CCP sets targets, leaving local governments to find their own funding solutions. Tax revenue flows to Beijing, forcing local governments to get creative in financing local projects. One common approach was leasing land to developers, enabling governments to profit directly from the real estate boom. As the Chinese property market slows down, the CCP introduced 3 red line policies for property developers to prevent a debt-induced collapse. This policy significantly reduced revenue for local governments, putting some at risk of default. Local governments couldn't borrow money directly, so they established entities called Local Government Financing Vehicles, LGFV, to issue bonds and raise funds. Investors assumed these were safe bets since LGFVs were safe bets since LGFs were government. However, these loans faced issues. In theory, these loans should be successful if they contribute to economic output exceeding the interest on the loan. Yet the problem arises when local governments borrow not to boost the economy but to artificially inflate GDP numbers to meet CCCZBU numbers to meet CCC goals. With no independent verification and the CCP awareness of the problem, fixing it would be catastrophic. After decades of false reporting, the discrepancies have piled up. Lying about a few percentage points is one thing, but correcting the data would reveal a significant deviation from reality, damaging China's global image and the CCP's credibility at home. No one has a strong incentive to address this issue. The central government doesn't want to look bad, and local officials fear severe penalties. So, how large and robust China's economy truly is remains a challenging question. Professor Luis Martinez's study, which analyzed GDP growth and nighttime light patterns from satellite imagery in various countries, offers some valuable insights. A study by Professor Luis Martinez suggests that China's GDP growth may have been a third slower than reported over 20 years, making its economy significantly smaller than the USA's. Dr. Yuri Scussfoot estimated China's actual GDP to be roughly 60% smaller than reported, unveiling the enormity of its debt problem. China's high debt to GDP ratio, fueled by constant borrowing and falsified GDP, poses a significant concern for the CCP future. So if you guys can just take a quick second of your time and tap that like button below it, helps me out a lot with the YouTube algorithm, especially when covering topics that are critical of the CCP. China's mortgage crisis. In 1989, the CCP shocked the world by violently suppressing democracy protests, resulting in the deaths and injuries of thousands of Chinese students. Recent events in China have drawn parallels to that historical moment, as Chinese citizens have initiated a unique protest against the CCP. They are boycotting mortgage payments on their homes through social media, seeking fair treatment from the CCP and banks. Protests have erupted in various cities, and the movement is gaining momentum. The CCP response has included deploying tanks, marking the first time in over 30 years that they fear for their rule. This crisis centers around China's real estate bubble, which the CCP views as a political protest rather than a banking crisis. Government officials are deeply concerned about the situation. Additionally, China faces the risk of a recession with a massive protest over frozen bank deposits and the potential collapse of big Chinese banks, putting over $9 trillion in loans in danger. This crisis has the potential to bring about the collapse of China and the CCP. The Chinese real estate market has been a significant cultural and economic force for decades. Real estate ownership is deeply embedded in Chinese culture, serving as a retirement plan, a factor in marriage prospects, and a symbol of social status. The demand for real estate has consistently risen, driven by the belief that prices will only go up, similar to the 2008 US housing market. This led to a massive rush to buy properties, with developers selling units before construction even began. However, many of these homes remained vacant as owners bought them solely for price appreciation, resulting in oversupply. Chinese families had approximately 70% of their wealth tied up in real estate, making them highly vulnerable to any disruptions in the property market. The recent crisis surrounding the collapse of Chinese property giant Evergrande, marked by an 80% drop in company shares and the demolition of unfinished towers after years of stalled construction, has exposed the risks associated with the excessive reliance on the real estate sector in China. Evergrande capitalized on China's real estate boom, rising to become one of the country's largest developers. In 2018, it held the title of Asia's largest real estate company. However, the sheer scale often masked questionable practices. Amid the frenzy for real estate, buyers paid for homes before construction even began. Typically, Evergrande secured land leases from local governments, sell homes on that land, and pocket the money up front, diverting it to acquire more land for future developments. This practice was unsustainable and raised concerns about oversight. The responsibility for regulating this fell to local governments, which, ironically, benefited significantly from leasing land to companies like Evergrande. Approximately 50% of local government revenue relied on such land leases, creating a conflict of interest as the same entities responsible for safeguarding citizens profited from risky practices. This exemplifies the issue of perverse incentives, not to mention the corruption associated with land leases. This played a significant role in the expansion of China's real estate bubble, as regulators were slow to intervene, benefiting directly from the situation. The CCP attempted to regain control by implementing the 3 red line policies for property developers, but it was too late. Evergrande's debt problems persist, with angry suppliers protesting unpaid bills and bondholders losing patience. These questionable practices extended to Evergrande, listing these sold houses as assets on their balance sheet to secure more loans for construction, despite already being sold to others. Nearly every real estate company in China operated similarly, leading to over-leverage across the sector. This unsustainable model resembles a Ponzi scheme, reliant on perpetual growth. However, once trust in Evergrande's solvency eroded, triggered by missed payments, chaos ensued. The crisis deepened, affecting small business owners and homebuyers eagerly awaiting completed properties. Investors, expecting refunds, protested as news of Evergrande's potential $300 billion loan default triggered widespread panic. The real estate sector, laden with $5.3 trillion in debt, showed signs of collapse. In 2021, the CCP intervened, but progress remained sluggish. Sales revenue primarily serviced debts, leaving many 2019 projects incomplete, some eventually demolished due to delays. Frustrated homeowners faced endless construction delays and excuses. Some had invested their life savings and reached a breaking point. On July 1st, homebuyers in central China collectively declared they would cease mortgage payments unless construction resumed. While one project might seem insignificant in a nation of $1.6 billion, the movement quickly spread. By July 12th, 100 projects had joined the boycott, and as of this writing, over 300 projects across China are withholding mortgage payments to draw government attention. Tens of thousands have intentionally defaulted, and protests have taken to the streets. Banks are failing. Amid these developments, 300 projects now represent over $100 billion in debt held by China's major banks. The issue isn't just the debt amount, but the increasing number of participants in the mortgage boycott. The CCP has instructed banks and news outlets to cease reporting on these boycotts as they perceive them as a political protest rather than a banking crisis. This situation poses an existential crisis for Chinese banks, potentially dwarfing the 2008 American banking crisis. One critical distinction is that most of these loans are collateralized by unbuilt houses, preventing banks from repossessing assets upon default. Instead, they face absorbing these losses, and if defaults continue to rise, large banks may face collapse. Chinese banks usually operate with a fractional reserve system, where they can lend out a portion of deposited funds. If too many loans turn worthless, trust in banks erodes, leading to potential bank runs and collapse. This financial sector turmoil poses a significant challenge for the CCP, given the reliance on real estate and finance in China's economy. The CCP is contemplating injecting over $1 trillion into real estate firms to complete these projects, despite its prior reluctance to bail out failing companies. Censorship around this topic has intensified, reflecting the government's fear of further protests. Sluggish export and import. At the heart of Shanghai's Minhang district, we stand before a desolate supermarket, its doors firmly shut, devoid of any customers. This area once thrived as Shanghai's hub for musical instruments, but the transformation is striking. Many instrument shops have faded away, leaving behind empty storefronts. Crossing the street, we find a solitary shop valiantly open for business. The man behind this video laments that what was once a vibrant musical instrument street is now reduced to a few hotels and office spaces. This decline reflects a significant drop in consumer demand, signaling the end of an era. The situation is compounded by global shifts, as countries like the U.S. redirect their orders to nations such as India and Vietnam. This double blow of weakened overseas demand and sluggish domestic spending has taken a toll on businesses. China's economic struggles persist, with declining imports and exports in August, adding to the challenges faced by the manufacturing sector. Escalating real estate debt, fallen property prices, and wavering consumer and investor confidence have further eroded both domestic and international demand. Analysts have revised China's growth forecast for the year, doubting it will reach the government's target of around 5% annual growth. While some stabilization is evident in recent trade data, the road to recovery remains long and uncertain. The Chinese government has introduced measures to stimulate economic growth, including relaxing lending rules to support potential homebuyers. However, these efforts may have limited impact due to a slow labor market recovery and income uncertainty. China's economic activities are also hindered by COVID-19 policies and decreasing household incomes. As a result, China's trade surplus in August fell short of expectations, exacerbating concerns about the nation's economic outlook. These challenges pose a formidable threat to China's economic stability and future growth prospects. On September 5th, a grim reality emerged. Demand continued to decline, and efforts to jumpstart the economy were falling short. The Purchasing Managers' Index, PMI, for China's service sector hit a new yearly low in August at 51.8, down 2 percentage points from July. Despite this drop, it still hovered above the 50-point threshold, which marks the division between growth and contraction. In recent years, spurred by the U.S. government's efforts to reduce economic reliance on China and vulnerabilities exposed by the pandemic in China's supply chain, American companies have been revamping their supply chains. This shift has benefited countries like Mexico and Vietnam, which have witnessed a surge in foreign investments from both China and other nations. Over the 12 months ending in July, Mexico's share of U.S. imports hit a 30-year high, averaging about 15%. Vietnam, while slightly below its 2022 peak, stood at nearly 4%. For decades, foreign investments played a pivotal role in China's economic ascent, forming a critical component of its economy. However, recent indicators paint a different picture, with China losing its allure for foreign investors. Key investment metrics have plunged to historic lows, unseen since the 1990s. This includes a decline in direct foreign investments last quarter and a spike in liabilities stemming from foreign business investments. World Bank data underscores this trend, revealing a significant drop in net inflows of foreign direct investment in China last year, returning to levels last seen in the 90s. Foreign investment in China has sharply declined, dropping nearly 50% compared to the previous year. The Chinese Ministry of Commerce disclosed that the use of foreign capital dropped by about 10% from January to July this year. Moreover, foreign investors are rapidly selling off Chinese stocks, with a staggering $12 billion worth of Chinese shares disposed of in August alone. These shares make up almost 31% of the MSCI Morgan Stanley Emerging Market Index. In conclusion, China's economic miracles seem to be unraveling at an alarming pace. Despite the facade of robust growth, cracks in the system were becoming increasingly evident. The opaque nature of GDP reporting, questionable practices in the real estate market, and the looming mortgage crisis had shaken the foundations of China's economic prowess. As protests and uncertainty loomed, financial crisis, declining foreign investments painted a bleak picture for the nation's economic future. In a world marked by uncertainty, one thing was clear. China's economic future hung in the balance, and the world held its breath, waiting to see what would come next.
And that is today's episode. If you found this video informative, please subscribe and ring a bell to get notification. Thank you for watching and see you next time.